529 plans are, at the simplest, are a college savings plan that offers tax benefits. They're generally administered. Each state has their own 529 plan, so they're who administers them with the help of a certain financial firm. Maybe it's Vanguard or Fidelity or Morgan Stanley, Prudential, on the various states' plans. A bit of history on 529s. They started off for a good decade as just prepaid college tuition plans offered by states. Michigan had the first one in 1986, and these were, you put in a certain amount of money, and you had, Florida State, say, was paid up. So it was prepaid college tuition for just state schools. That was expanded a decade later, and the 529 number comes from the IRS revenue code that authorized the tax-free status of qualified tuition plans. Today, they're very popular. There's over 14 million accounts and 352 billion in assets in the various state 529 plans. To give you a sense of where college costs are, wanted to give you some various numbers of schools and what it was in the past for UNC Chapel Hill, very popular school. It's the #3 ranked public school right now, so very good institution. In 2000, so 20 years ago, in-state tuition was less than $3 grand, $2,768 for in-state tuition. That's now more than tripled to over $9,000, and that's just tuition. And so that's a growth rate of over 6% a year. Out of state, obviously, every out of state is higher at any public school. It was a little less than 12,000. Today, it is 36,000 for out of state tuition. Again, this is just tuition classes. So 36,000 out of state to send UNC. Not as high growth rate, a little less than 6% there, 5.68%. So all-in cost to attend UNC today for in-state are $21,516. That total cost, this is just tuition, room, board, and books and supplies, a cost that would be covered essentially by a 529 plan. These don't include extracurricular, sports tickets, etc. Out of state, 48,500. So college has gotten very expensive. We all know that, but actually seeing the numbers is somewhat shocking. Actually, just the growth rates there. Some other schools for you, some common schools. NC State, another great local school here in Raleigh. It's 24,000 in state. That's room, board, and tuition, and books. And out of state, it's 43,000. Duke is 60,000. Duke is a private school. I actually just saw Grant Hill being interviewed, famous Duke grad. 60,000 to go to Duke. Now, some of these schools, if you go on their website, they'll say that, well, financial aid, and certain percentages of students get financial aid. At UNC, at 42% of students, they say get financial aid of some sort. The acceptance rates at UNC is 25%. Duke says that 56% of their undergraduates get some form of financial aid. So it's a bit like buying a car. You maybe won't pay that stated rate, depending on your situation, but the stated rates are pretty high. Michigan, my alma mater, is 61,000 out of state. It's one of the more expensive public schools for out of state. The most expensive public school is UVA for out of state students. It is #1 in terms of cost. Harvard, just to give you an Ivy League number, is almost 67,580. And then Rutgers is for our East Coast, Northeast clients. The state school in New Jersey is 28,000 and 45,000. So across the board, very expensive proposition for parents today. So some benefits of 529s. The main benefit is tax-free growth. You put in $10,000 today when your son or daughter may be born, and in 18 years, if that's doubled to 20,000, and you use that for college, that growth of 10,000 there's no tax. So that's really the main benefit is that tax savings. You have some investment potential, similar to 401k in terms of your options, but some potential to exceed that cost inflation of what college has been of around 6%. We'll see with the virus. Maybe college tuition costs slow down a bit going forward with everything going on. It's certainly possible. But the last 20 years, it's been about 6% a year. There's no effect on financial aid. That's a common question that we get. The 529 is technically owned by whoever starts the plan, either the parent, maybe it's the grandparent, could be an aunt or uncle. They are the owner of the plan, and the child is just the beneficiary. So if there's any sort of financial aid, that doesn't impact that calculation. Some states offer tax deductions. 30 states do. Something like 7 or 8 states offer deduction regardless if you contribute to their plan or not. They offer that deduction. A lot of the other states, you have to contribute to the state plan. So if you live in South Carolina, you have to contribute to the what's called the Future Scholar Plan, which is the South Carolina 529, and you get a state tax deduction. North Carolina does not offer one. New Jersey, for example, does not offer a tax deduction. So there's no incentive to use the state of North Carolina plan. If you live in North Carolina, you want to choose the best plan out there. Other nice thing, anybody can contribute. Parents, grandparents, instead of buying your kid a toy or something, say, hey, put $100 into their 529. A lot of people like to do that, particularly grandparents. In terms of the maximum that can be put in by any individual, it's 15,000 individually or 30,000 for a couple. So my wife and I could put in 30,000 into our son's 529 each year without triggering a gift tax return. The most common questions we get are some of these negatives here. What if we don't use the money for qualified expenses? And we'll get into what those qualified expenses are. But you would owe tax on the gains, and there would be a 10% penalty. Again, on the gain. So if you put in 10,000 and it was 20,000 and you couldn't use the money, that difference at 10,000 would be subject to tax and a penalty, similar to a early withdrawal from an IRA. The investment options are limited. Like I said, similar to a 401k plan, you have various options. It could be an age-based option. It could be an allocation type option, aggressive, moderate, conservative. But you can't just pick any stock or any fund or ETF that you want. You have certain options that each plan has. Something that we're a fan of are the direct sold plans. We don't sell 529s. It's a fiduciary. We don't think that's in clients' best interest to be putting them into advisor sold 529s that have much higher fees. So we assist clients in opening these, but it's something that we just do as kind of an added side benefit. But the advisor sold plans do have higher costs associated with them. And then like any ETF or fund that you own, there are embedded fees. For example, I use the New York plan, just administered by Vanguard. The fund fees are 13 to 15 basis points. So there are some fees, although not significant, with the New York State plan. So what are qualified education expenses? This is again a common question we get. This is a question we get from parents who kids are just about to go to college. So first would be tuition, room and board. Room and board is for college only. It's not for a boarding school at Exeter Academy or something like that. It's just for room and board for college. K through 12, this is something that changed in 2018, that K through 12 tuition is now can be used up to $10,000 per year. Books, supplies, computers are also qualified expenses. And then student loan payments is something, again, they added in there recently. What are not qualifying expenses? Travel. If your son or daughter goes to UCLA, those flights back and forth to LA don't count. Can't use it. Health insurance, any other testing or application fees that may be involved, extracurricular, meals, going to a UNC basketball game, that's out of your pocket. Can't cover it. Again, back to that common misnomer in terms of using the money, and what if little Timmy doesn't use the money? How do you avoid paying taxes? And one, you can change the beneficiary. You could change it from your son to your daughter. You could actually, if you had a grandchild, once your son grows up, doesn't use it, you can move it to your grandchild way down the road. So it could be kind of a legacy building account that way. If your son or daughter doesn't need it, you can use it for graduate school. A lot of kids are going on to law school, med school, MBA. So you can certainly use the funds that way. So there are some uses for it beyond your own son or daughter. So I always say it's pretty low odds that you're not going to need the money. We get the question of what if they get a full ride scholarship? Certainly possible. We know people who've gotten them, but the statistics say it's 1 in 1,000. 1 in 1,000 college students get a full ride. That's 0.10%. So again, it's pretty low odds that the full ride will come through, and you won't need any of it. So it's certainly there are ways to get around paying taxes. And then the last page, I wanted to walk through a case study, very rudimentary, but just to kind of give you a sense of really, what someone would need to save starting today for the future. So we have Mike and Jennifer here. They just had a baby girl in May, and they want to open up a 529 plan. And again, another common question we get is, well, how much do we need to save to it? In this example, I said 4 years. Usually we say if you have 3 years covered by the time they're 18, that's a good goal. For this example, I used 4 years. So main assumptions was your investments grow 7% and college costs at 5%. So when they're 18, how much do you have to save annually or monthly? And if you want in-state tuition covered, you have to save over $6,000 a year or $500 a month. That's a lot for a lot of folks who just had a baby. We know how expensive children are. So $500 a month for state, have 4 years of state school like a UNC covered. For out of state, Ivy League, out of state, those are all fairly comparable cost wise. Out of state, it's a mortgage payment. You've got to save over $1,100 a month, $1,140 or $13,735 a year for 18 years to have 4 years of an out-of-state school. So it's extremely expensive. Why a lot of grandparents get involved and help out some. It's a great way to help there. But just to kind of see those numbers is pretty shocking. And it's, out of state is a mortgage payment. So these are things we can run as advisors in eMoney. You have an exact school either you want to use in an example. We can put in various assumptions, change how much you're saving, how much you need to save. eMoney has a great tool for that. Let us know. We're happy to help out. Any questions you have regarding 529s, reach out to your advisor. In closing, they're a great option. We're big fans of them. There are some downsides to know about, but we think the tax benefits certainly have outweigh any of the downsides. So again, reach out to your Altrius advisor with any questions on 529s.
Great. Thank you, Chris. I know you have a young guy at home, and I got 2 little ones, so these numbers are just, they're fun to look at, but important to plan for. All right, Greg, you are up. I'll hand it to you. Do's and don'ts.
Excellent. So something we always kind of talk about during our advisor meetings is just, how turbulent the market is. Every day you can, for a while there we were seeing the markets go up 1,000 points a day and down 1,000 the next. And I think just these are some of the do's and don'ts that we try to recommend to our clients that have a real strong into planning, a tie into planning. The first is really do revisit your current expenses. With somewhat of an unknown going on in the markets, people not really understanding, while it does seem like we are going to be opening up and getting the economy at least, trying to open up. Spending has been low. A lot of us, we've kind of talked about it. We haven't really been going anywhere, so it's maybe been easy to cut excess spending to a degree. But at that same point, if you are going to be going out and, being socially safe, maybe not so much of, trying to, limit that excess spending now that you can go out and spend it a little bit more, is a prudent kind of thought process. And additionally into that, delaying big purchases, things of, potentially buying a new car, doing a renovation to your home, maybe purchasing a second home. All those things, at this stage in the cycle, I think are worth to speak about with your advisor here at Altrius, just to say, take a look at what your cash flows look like and potentially think about, does it make sense to still go after that large purchase or project, or does it maybe make sense to kind of wait that out, say 6-9 months down the road to see how we kind of flesh out in this cycle. A big don't, as we recommend, is don't watch CNBC or the news all day. It's incredibly difficult, myself being a sports fan, to not have sports to watch and just a limit of, other things that, are no longer at our disposal. It's great to stay informed, but it's easy to get caught up in some of the sensationalism that's out there. And just remember, as much as these information and outlets are informative, it's also a sense of entertainment. You will see that these news channels do like to say everything is breaking news, just to kind of get your attention. So kind of take everything with a grain of salt. And if you see something on the TV that you want to talk about, we're here to kind of talk to you from a more fundamental standpoint as well. On a do perspective, certainly find time to do the activities that you enjoy. It's good to, for a while, I think a lot of us were locked up. Myself here in New Jersey, we probably didn't leave the house for probably about a solid month, but it is, it's important to get your emotional and mental and physical health in just as much as your financial health. So try to get outside and exercise, see people, your friends and family, and just, obviously be safe when you're doing it. Continuing, a big thing for us, and especially in our approach that you guys have come to love and enjoy, is don't try to time the market. Getting back to some of the positive parts that you may see on TV, we can all get excited about certain businesses reopening, the potential of a vaccine being developed, but it's very difficult to buy something at the low, and if not impossible, and then to get it out at the high. So don't try to time certain companies because you think something's going to happen. Here at Altrius, we do a fundamental analysis of each of these businesses that we're looking to either lend to or own long term, and we're not just looking to invest in hope, essentially, thinking that a vaccine is going to be created by one of these companies and it's going to provide a big pop. Do review your financial plan. I think the main questions that we need to start asking ourselves is, after this cycle, and we've seen a little bit of a pullback, is has your risk tolerance changed? Perhaps maybe you're invested a little bit more in equities than you'd like to be, and I think that's something to certainly take a look at. Also, do you have any new obligations or responsibilities? Obviously, in one instance, as Chris mentioned, the college planning is great. Some of you may be having to take on responsibilities of elderly parents or, potentially siblings, if that's the situation. So just kind of, it's a good thing to always redo an audit of, again, what are the responsibilities and expenses did you not necessarily think were in your plan a couple years ago, and now they are for certain circumstances. And then probably the most, the biggest point to go after here is don't panic. Yes, we are living in some very troubling times, but remember, we've created plans for you for the most part. Go over them again with your advisors. We're here at, an email, a call to just, go through everything with you and, review those plans and navigate through those times. So don't feel shy when reaching out to us.
Great. Thank you, Greg. All right. Lastly, I'm happy to review some questions we've gotten from clients during this, crazy year so far. I will just preface it and say that there isn't really a right answer to any of these questions. It depends on the situation. So there's a right for you answer, but really, as you'll see, I'll start all of my answers with it depends on your situation. So that's where speaking with your advisor really comes in. But without further ado, I'll go ahead and start sharing some. So I'm thinking about buying a house or relocating. This is something that we've heard. I've helped and seen my own family start to do this. My in-laws put their house up in New Jersey a few weeks ago. It was on the market for less than 4 days, and they had 7 offers, all over ask. So the market is really hot right now from a lot of people flooding these hotbed zones in New York and Jersey City and all the big cities, right? People are questioning, do they need to live there in this pandemic age, knowing that they can work remotely? So it is a question that we're getting. And again, there's no right answer. It's only what's right for you and your situation. But it's something that we can build into a custom plan for you. We can take expense figures and how much you want to spend on a house and what the future mortgage payments are going to be, and all, build that into your model to make sure that it is, within your means and within your long-term goals and objectives. But it's clearly a question on people's minds, especially if you're in those bigger city areas. And there's potentially some real tax savings from there too, right? I mean, why do you have to live in Manhattan if you can do your job remotely and live in Florida where there's no state income tax? So an interesting question and a topic I think that is going to be around here for a while, with interest rates being, super low, historically low, and people working more remotely and not having to go physically to an office or live in a city to work anymore. Next, should we wait until the market drops before the election to invest more or begin investing? In an election year, this question comes up all the time. And I'll go back to just 5 minutes ago when one of Greg's don'ts was don't try to time the market. And I'll say that's true here too. Certainly election years do bring more volatility. This year, I'm sure it will be the same, especially given the, all of the current events that are going on right now. It's going to certainly be a hot election year, no doubt. But when you start to look at things and you peel back, relationships between the government and the market, is there really a correlation there, red or blue as president or red or blue as running Congress, and what their effect is on the stock market and a company's ability to buy or sell its product and generate a return for investors. And I've seen many studies out there going back to the 1700s that show there really isn't a correlation or any relationship between the president or Congress and the stock market. Headlines, if you're watching the news all day, they will play it up all day long that there is, but it's their job to get eyeballs and get engagement from viewers and attract advertising dollars. It's not necessarily to give you the real news. But without getting too political there, it's best to avoid market timing situations, and before you make any decisions or want to do anything, speak to your advisor, give Greg a call, give Chris a call, give me a call, give Jim a call, have us run a plan for you. We can model out a number of scenarios and hopefully give you some peace of mind. But what's going to happen over the next 6 to 12 months, I'm more than confident that 20 years from now, sticking to your plan will be ultimately the right decision. What is the right amount we should have in cash? Again, no right answer, just what's right for you. There are some financial planning, rule of thumb numbers that you could find out there where it's a good idea, people say, to keep anywhere from 6 to 12 months of your living expenses in cash. And in conversations with clients, I've definitely quoted that number before, but it really does depend on your situation, what your future goals and objectives are, what your lifestyle is, how much you spend, how much you earn, how much saving power you have already. So it's a seemingly simple question, but it does have could have a lot of nuanced answers. And it, again, depends a lot on, really entirely on your individual situation. But it is, again, something we can model for you. We can incorporate a cash portion or a safe portion as a part of your overall plan, and bring that into the eMoney planning tool that we use. So if it's important to you to have that safe cash bucket, certainly communicate that with us, your advisors, and we could come to the number that's right for you. When should I start taking Social Security? Another interesting question. You can start taking Social Security as early as 62 at a reduced benefit than what you would receive for your full retirement age. And depending on when you were born now, full retirement age is either 66 years and 3/4, 8 months, or 67 years old. You can defer taking your benefit until age 70. And each year that you defer past your full retirement year, you get an increased benefit as well. So there are a lot of different scenarios and things to look at. There are certain things you could even take advantage of to maximize your benefit. But Social Security can be complicated. It's a whole big calculation based on your highest 30 years of income. And it's actually a topic we should probably spend a little bit more time on. So maybe a little teaser here during our July webinar. Maybe we'll do a whole thing here on Social Security and strategies around it and implications around it. But yeah, Social Security is something that there's a model for it in our planning software, so we can incorporate that into your plan. Sometimes it could make a lot of sense to take early and not wait until you receive your full benefit. Other situations, it certainly makes sense to wait till you receive your full benefit or even defer all the way to 70. So again, a lot of different things you could look at there, but it's so dependent upon you and your individual situation. So speak with one of us. We'd be happy to run scenarios for you and discuss it in greater detail. And we'll run we'll have this be a topic in next month's webinar as well. And that's it for our formal presentation and remarks. So I'm going to open up the lines here in a second, and please, anyone feel free to jump in if you have a question, throw it out there. You can also enter the chat box. You should see a little chat icon in your GoToMeeting screen. Feel free to type in a question too. But I'm going to pause now. I'll open up the lines and hear from you. No questions. All right. Greg, Chris, you guys did a good job covering everything.
There you go.
Nice job. All right. Well, if there aren't any questions now, feel free. Email us, call us. We're always available. Thank you again for taking the time to join us tonight. And again, apologies for the error link in the invitation. We will do our best to correct that next time and look into why it happened. But thank you for being here again. Stay tuned for our next live planning webinar in probably mid-July, in about 4 weeks. And again, yeah, happy to help any way we can. Reach out to us if we can do anything for you.
Thanks, everybody.
Thanks, everyone.
Thanks.